A'udhu billahi minash shaitanir rajim. Bismillah ar-Rahman ar-Rahim. Greetings, traders. It is I, Abdul Shabazz, and this is Some Real Change Stock Options Trading Journey. Thank you for joining us this fabulous Friday, the best day of the week, Yaumul Jumu'ah. Grateful to be here with you. Big shout out to those of you who caught this beautiful put yesterday. Let's go ahead and get our charts together for today. Beautiful put, worked great yesterday from the 690 to the 685. It'll be very interesting how today goes. Seems as though as if we're in a larger selling algo.
Hey Rashid, you still in London, mate?
Huge gap down from yesterday's close. A $5 gap down. Got a picture of what has happened here. We worked our way down there. So now we're here this morning. This could be a potential here also. Probably more like it for today. That's probably more like it for today. Let's get rid of this. $685 call. $685 and above for a call. Call will be around that 685.7 area. $687.8, $687.7 rather. 689.3. Alrighty, those are my plans for a call. 684 entry, 684 strike, 685 7 entry, 687 first profit target, 689 3 second profit target. I'm getting so sick of these telemarketers. I don't know how they're getting around that scam likely. We used to get, notifications whenever they were calling to say scam likely, but that hasn't been working lately. $689.5 possibly. And for the put, if we're going to come down and do a put today again. Todd, what's up, buddy? $5 gap down. Need a bounce. As we head into the last day of the week. It's going to be kind of funny today. It's a Friday, last day of the week, last day of the month. So it's the last day of the week and the last trading day of the month. Down at 681, get a bounce back, and then potentially. So I like to see a drop to the 682, bounce back to the 683.4, then come down to the 679. I like to see this, then a bounce back, then that. That is what I would like to see. Will we get it? Who knows? So we'll go with a 684 put strike. 683.3 for entry. After a bounce. $681.9. And then wrap it up with 679.3. Okay, let's put that on the big chart and see what that looks like. Again, big gap down this morning. Big gap down this morning. Todd, how you doing in your position from yesterday? Are you still in it, or did you get out at the end of the day, or what did you end up doing? Big control selling algo coming into this morning. Yeah, that is right there. All right, let's see how these plans look with this. $685.7. Yep, for the call. I believe we could take that to 689.5. I do have that for a second profit target. 687.7 for a first profit target. I ain't too mad at that. Put the alarm at the 685.5. Looking for a 685.7 for entry. Okay. And now for this put. She's already where I want her to be at for the put. I think a bounce and then a drop like I showed you before. 679. Let's move this to 680. This is not looking good right here. 680. It's definitely possible there. 680. I don't know where else she can go. Adjusting my plans a little bit after I look at the big chart. $686. $680.6 and then 679.8. $683 strike. I still like this 683 area, but I like to see a bounce. I don't know if I want to chase it because she could hit that. Like I said, what I want to see is come on down 682, bounce back to 683 higher, then let's grab it on the way back down. So I'm gonna put the alarm at the 682. Hopefully we might get there and bounce. 682. Okay. 682 too. We're gonna get there and bounce our way back. We will keep up pre-market. It is important today, coming into today. Again, looking for the market to come on down, then bounce, then give us that put opportunity. Don't want to chase it into the open because she very well could bounce at the 680.50 area. Very interesting on that. So those are the plans for today, with alarms set and in place. I'm gonna alarm at the 587.5. Look, I'm sorry, 680. I don't know what's going on. Maybe I need my glasses or something. Put my glasses on. I'm having a hard time seeing. Okay, I'm having a hard time seeing. So like a 684 strike, 685, 7 entry. Take that to 687, 7, and then 689. 689, 5. For put, I like where she is now, but I don't like it coming out of the gate. I like to see a bounce back towards that 683.3, and then bring it on down to the 680.6, and then the 679.8. Those are my two alarms. One at 685.5, one at 682.2. Expecting a potential bounce here to 681.9. This is a monthly area of support. Very interesting morning. Again, keep in mind it's Friday, the last day of the week, and the last trading day of the month. So you don't want to rush into anything today. Take your time. Alrighty. I know, right? Man, Todd, I'm about fed up, but I think I'm about done with these swings. Those green got an early good morning at Kosi. Todd said I haven't mastered forecasting the future, buddy. No one has. That is for certain. So I do like the fact that I'm becoming more patient, but I don't think I can apply my day trading to that overnight swing. You just can't control what you can't control. That which we can see, we can aim at, we can shoot, we can come up with a game plan. That what we can't see, we're flying blind, strictly at the mercy of the market. And that's just not a very comfortable place to be in. Not a very comfortable place to be in. Quiet Soul is in the building. Grand Rising, buddy. If anybody has any plans they would like to share, please feel free to put them in the chat. My plans are as follows. Calls is 685.7, taking that to 689. Put 683, taking that down to 679. That is what I would like to see this morning. Well, let's get ready to do what we do, see what the market yields and gives us this morning. Do want to keep up this 5-minute chart today. I'm sorry, the pre-market chart today, as there was a very serious gap down pre-market. Again, heading into the wrap up of this month. So I do like this view right here, and I believe we will go with this one. This is the view we will go with today. Start the market off with. Thank you guys for coming in. Thank you for hitting the like button. Thank you, Team Kick, for kicking it with us as well. It is appreciated. Let's talk about money. Big shout out to Keeps that's joining us on Kick. Alrighty. for 3 minutes rather till the bell. 3 minutes to the bell. If you have any plans you want to share them, please feel free, put them in the chat. Other than that, let's see what is going on. Let's check some news out. And Colsey said he's going to wait. Can't get a clear picture from pre-market or hourly charts. Definitely agree with you there, sir. We do have a picture, however, of a controlled selling algo coming into market open. So the bears are active this morning. The only question is it sustainable? And our teammate is in Colsey reminding us he wants to let the picture become a little bit more clearer, allow the chart to form a little better, allow us to be able to see what the market is trying to show us. Couldn't agree more, teammate. As we begin, let's wrap up this week strong, close out this month strong, and prepare. Next week, we will officially be in the bottom of the first quarter of this month, and that is with March. March represents the end of the first quarter of this year. Can't believe we are already there. Time is flying by. Here we go, team. Let's get ready to do what we do best. Use our superpowers, and that is having the ability to wait, allow, and look at. And again, on Fridays, the word that we've been using lately on Fridays is that we're looking for the obvious trade. The obvious, clear-cut setup, the obvious trade. Shout out to Jared Lewis, who just joined us as well. And here we go. I like this. This is that bounce that I was looking for. Out of the gate, I like to see that bounce and then a potential retracement below the 683. With that adjustment, I will move that entry from the 683.3 to the 683 itself. With a rejection at the top of the algo, right out of the gate, right to the top of the algo, straight rejection. Look like it's trying to give us that play a little early here, huh? Gonna continue to be patient. You know the first 5 minutes is very volatile. The first 15 minutes can trick you. But this is that stuff that we wanted to see. That bounce out of the gate. That stuff right back down through that 683. Perfect opportunity for a put. Just need a little bit more time, and not just before we take it. I want to see that confirmation before that continuation trade. I want to get tricked by all this volatility. Big gap down over $6 from yesterday's close so far. And Colsey reminds us this is a huge change, 180 from last week. So I won't trade if he doesn't have a confirmed move. He is absolutely looking for the obvious setup. Big change from last week. I myself am looking for an obvious trade today in order to get involved in. Have my alarms set in place. I'm going to move this. Let's put alarm up though. Right back to the top of the algo. Huge gap down from yesterday's close. A fine morning to be in the market. Jesse Swanson is in the building, team. Shout out to you, Jesse. Thank you for joining us. Grateful for you to be here. Looking for that obvious trade today. Giving the market some time to develop. Latest news, U.S. stocks have taken a turn for the worse after the PPI inflation data. Stocks sell off on tech struggles and a hot U.S. inflation report. What is going on? What is going on? Well, I've given you all my plans for today. I'll give you my plans here. Looking for a 684 strike, 685 7 entry, 687 7 profit target, 689 5 profit target. Come on down. Well, let's do that. If we're going to do that, let's back it up one more. 684 strike, 683 entry, 680.6 first profit target, 679.8 second profit target. On the trading view chart, this is exactly what that looks like. Looking for a continuation in the downward direction before I get involved in a put in this 683 area, bringing on down to 679.3. Looking for a reversal. Possibly these bears may want to take profit, put themselves in a position to do so. Not looking for that to happen until we get to around 685.8 area, and this is where I would like to see a call in this area. That is what I have planned for this morning. Big Ben in the building. Finally. Good morning. Yes, indeed, buddy. Shout out to the team, everybody, for being here. I just wanted to show you guys my plans. Turn it over to CNBC. Let them do the talking from here to express what everyone else is thinking. Here we come. This is the desired area I was looking at.
It's over. Battle for Warner Brothers Discovery has ended. Don't think I won't still be talking about it, though. I will occasionally, but
why not? How much is Larry
decided.
Ellison? What did Larry Ellison do to make this thing happen?
Well, Larry Ellison guaranteed the equity, which is some $43+ billion. Now, it doesn't mean that he's going to be providing all of that equity. In fact, right now the expectation that I've heard is he perhaps will provide as much as $14 billion of that. They've got a lot of other investors lined up. Redbird is their partner. Redbird could step up, from what I'm told, for a number that could be as much as $4 billion after already investing $2 billion in the Paramount Skydance deal. Remember, Mr. Ellison put $6 billion into that deal. But overall, it's $31 a share. That's why you're seeing Warner Brothers stock price adjust a bit, because there were those in there hoping that they would get even higher price if Netflix had chosen to come back, which they did not. I am told, Netflix believed that they would have had a bid at least $2.50 to $3 a share higher. You put that on 2.6 billion outstanding shares. It's a real number. Instead, they collect, by the way, a check for $2.8 billion, which is about to be sent. The deal hasn't yet been signed. It's going to be signed any minute now, and then they'll get their breakup fee, Netflix, $2.8 billion, and go on their way. And obviously, their shareholders would seem to be happy about that. The challenge for Paramount, of course, will be delivering on the $6 billion in synergies that they see as available to them with this deal. There is some of what's going on here in terms of the ticking fee. That's important because from what I hear in the Paramount camp, there is really a hope that they will get this thing closed prior to having to pay that ticking fee. They've got the U.S. already in terms of antitrust, it would appear. Europe could be more difficult, but they think that they've got that lined up, perhaps, we'll see, for, let's call it July or August, and so hope to close well before that 25-cent a quarter ticking fee would play in. Stepping back, what a battle this was, guys. You could argue with the original leak on this before they'd even made their real approach. Probably was a real hindrance, a mistake. I don't know where that leak came from, but it didn't help them on the Paramount side. They started at 19, awfully low, and they were very incremental. All of which I'm saying is you can look back on their bidding and say, well, was there an opportunity here to have acquired this at a lower price? On the Warner side, well done, guys. $31 a share. When I went back in my look at this thing. I mean,
no.
When I went back to literally like page one, people were like 24, 25 would be a great outcome.
Right. Well,
and they got 31.
Go back to the fall of 2024, and I happen to know David's outside of the office, as many people do. He part of the hiring of me at CNBC. And if the stock was at 7, And he said to me, it's worth 28. And I was like, yeah, I'm worth 28. Do I see it 29? No, we said it's worth $28, and we're going to turn around the studio. We're going to get Europe for HBO, and it's going to happen. And the people who are selling it at 7 will not feel good.
So when you were calling for 34 as a number that could get it done, is this a bargain for Peace Guy?
Well, I thought that Netflix would come back for one more.
It was somewhat surprising they chose not to come back.
Looking
at least
for
one
close
more
in this
go-around.
area.
As I said, they
Looking
saw
for close
it
in this
having to raise
area,
as much as
and then a
3. There was an
continuation candle.
expectation that Paramount wasn't done, and in fact, my reporting would indicate that's true. They might have been able or willing to go to as high as the number you just mentioned, Jim.
Yeah.
We will not know.
That had been my level.
We also don't know what Netflix, and I haven't been able to really understand, Carl, what they really saw on the antitrust front.
That's a good point.
They have maintained they could get this deal done. Warner Brothers board maintained that they believe Netflix can get the deal done. What happened yesterday
At the White House?
At the White House, I don't really know. But that's, there are many who think that had to figure into this. I just don't know.
Okay, but all right. So Netflix wanted the studio really badly. Now, what are they going to do? Turns out they didn't need the studio that badly.
Well, they always said it was a nice to have, not a need to have. I will give them that. They always talked about price discipline. They obviously made a bid that they thought was a good, strong bid, and they stuck with it until it was clear that Paramount had addressed all of those questions around certainty that I've gone through so many times here, and ultimately was able to then get not just to the number, but to the outcome in terms of certainty that the Warner Brothers board desired.
Okay, so Netflix is a $386 billion company.
Yes.
Is Larry Ellison a bigger company as an individual than that company?
I don't know. Where's Oracle's stock price? Probably not quite, no.
But, I mean, he can write a check.
He can. Now, we don't know how much. Listen, nobody questions his ability to fund this and/or, if things don't go well, to put more equity in, as he, by the way, is now also committed to do. Remember, that was a key part of creating certainty, saying that, well, if Paramount were to run into a really hard time in the next 6-9 months or so, and the banks didn't want to fund, you got to make sure they do by putting even more equity in. So, yeah, he's a believer, I guess, Jim, and we'll see whether they can take this company into the new future of Hollywood and compete with the likes that we talk about so often of Amazon, of YouTube with great certainty, and of Netflix and everybody else.
Well, I want to applaud you, partner. A lot of people felt this thing was done, buried. Why bother to talk about it?
That's why we don't chase, team. That's why we don't chase.
Exactly
why we do not chase.
Outcome, and congratulations that you just said, you know what, I'm going to be on this one. Everyone else is done with it. I'm not.
No, it's been a great story to cover. We'll see about writing the book or not. I don't know.
That's exactly why we don't chase,
but it's
team.
gonna
That's
be a
exactly
good
why
one.
we don't chase.
Are we done
Here
with
is
the
what we're looking
political
for right here.
conspiracies that the deck was stacked for the liberal Netflix over the conservative Paramount?
Yes, I think we're done. And,
Yeah.
listen, the Paramount side also thought the deck was stacked against them to some extent, and I think that proved not to really be the case. And everybody had David Zaslav wanting this job and that. That was not true. It never was. But to your point, Carl, we're not done with the debate around CNN is now going to be owned with CBS. They're going to be together. There's going to be serious job losses. That's part of the synergy, $6 billion. When you're trying to find cost saves,
yes,
they're going to be combining news organizations, one would expect, and a lot more from there. So that debate, I would assume, will continue to rage, given the political climate in the country.
That's just an industry that is in decline. It's
Yeah.
not.
No.
There's been a time when you'd say, boy, the rates are going to go
Good
up.
job,
Guys,
Ben. Good
speaking
job,
of job
sir.
losses,
Good
back to
job.
our lead story this morning in many ways. The Jack Dorsey announcement, of course,
Right.
which is still reverberating in terms of cutting almost half of the company's employees, going from 10,000 to less than 6,000 at block. That stock is up. And
exactly
we've been
why we don't
talking
chase.
for months and months,
Needed to
for
see it
years
close,
almost now,
and
about
then
the
we want
impact
the
AI would have on
continuation.
jobs. I
That's
would note,
exactly why we
guys,
don't chase.
Andy Jassy was
This
asked
is
a
now
question
coming back to
on
my
Squawk
original
Box
plan, where I
that
said I
we've
want
been
to see
trying
us
to
come
entertain
down
for
to the
quite some time. I thought it
682
was worth taking a listen.
and then bounce back. Again, my original plan wanted to see us come down to the 682, then bounce back to the 683 and higher. And once it comes back down again, that's when we want to possibly enter a put. But knowing we don't want to chase, because I already spoken earlier about this 682 being a monthly area of support, and the bulls coming back in that area. They did it once in pre-market, so that's exactly why we wanted to see it happen once the market opened, to see if the same thing would happen. It did, right down to the 682, a bounce from that. Now we want to see if we do get the drop that we're looking for further continuation. If we do, great. If we don't, great. But we're looking for confirmation and then continuation before we enter a trade. It's Friday and we want to take the obvious trades. We don't want to be smart. We want to simply make money.
Outbreak of jobs that you want to buy, you want to build all the things that Corey says, you need to know a particular skill. And you can go back. So many people went to college, maybe they shouldn't have. Maybe that was the takeaway. That everybody, you have that liberal arts degree, and maybe you're going to have to do some shifting. And it's not so horrible. It's not.
Well, we'll see how many communities want a factory or a data center in their town, Jim. That's going to be the next source of friction.
Texas. Texas likes everything.
They like
everything.
They like everything.
They like it big.
Yeah.
It's Texas.
All your exes live in Texas.
It's a
Really?
good one. It's a good
I can't help it. I don't know. I like that
It's an
line.
interesting thought. New Mexico, they're willing to take jobs.
Dow is down almost 800. Amex the worst performer. Let's get Chicago PMI with Rick. Hey, Rick.
Hi, Carl. Indeed, this is a very good number. Our February read on Chicago PMI comes out 5 points higher than expectations, 57.7. 57.7. That would be the best level since May of 22. And last month's 54 broke a 25-month streak of sub 50. That was the first over 50 number since Nov of 22. So these are very important data points to pay attention to. I'm sorry, Nov of 23. And we hope that we start to see more manufacturing picking up in other numbers. Next week we'll have ISM and S&P on both manufacturing and service sector PMIs. Suffice it to say, the big news today is how bad equities look and 10-year note yields finally diving under 4%. Squawk on the Street will return after a very short break.
Take a look at the Dow, which is down 800. Almost half of that, roughly, is Goldman and Amex alone. Definitely a defensive crouch when you consider the leaders at the moment, which include Verizon, Merck's in there, Amgen, McDonald's. We'll watch that closely as we're holding on S&P, though, to 68.45. We're back in a minute. Jim's got his monthly club meeting in a couple of hours, and you've been talking about it all week. I got to know what you're going to say.
Okay, well, look, I'm going to talk about people who are whining, people who are right, and people who are wrong, and I'm going to go through the portfolio and be very hard on myself. There are 3 or 4 stocks that I literally say I'm wrong on. I've got to do something about, and they're big companies, and I think you got to listen. I really urge people to sign up because this is a very unorthodox meeting where I say that I am wrong on this one. I have to change.
Well, I mean, given the dispersion, the number of stocks that have hit new highs versus new lows just this month alone.
Yeah, but I mean, you got to buy drug stocks, you got to buy consumer packaged goods companies. You can even buy food companies as long as you stay away from people like, well, I like Michael and Trader very much, but of course, people who are spending beyond their means. And I think, by the way, just so you know, I cannot be bearish with the 10-year. I cannot be bearish with that PMI number we just got, which is terrific. And I am going to be saying that the data center and AI are positive.
Okay.
Okay?
Yeah. It's okay.
Zaz, $7, worth 28. There's a believer. All right. Thank you.
We'll see you tonight. Have a good
12
weekend.
o'clock today.
6 p.m. Eastern Time. We'll watch the markets this morning. Banks down 2%. IT down about 2%. Don't go anywhere. Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Picker and David Faber live at Post 9 of the New York Stock Exchange. Sarah's out today. As for markets, closing out February with a little bit of drama. Dow's down about 800. S&P back below 6850. Financials definitely a drag, along with tech. Some support from energy going into this weekend of Iran jitters. Healthcare and staples a little bit. 10-year below 4, and it has not cracked back above. Ahead this hour, OpenAI closing a massive $110 billion funding round with backing from Amazon, NVIDIA, and SoftBank. Tech investor Dan Niles with us to discuss. We'll talk to the CEO of cloud security company Zscaler, down sharply after results. And the latest, of course, on the Warner Brothers Discovery saga as the company deems Paramount's bid superior.
First, though, let's get some new economic data that just crossed. Rick Santelli has it for us. Rick.
Yes, David, this is construction spending for December. Also, they will be releasing very quickly November, which was not released yet. Up 0.3% for D's. This is 1/10 better than expected. And it really does underscore some pretty decent data. Chicago PMI was pretty strong. And interest rates, well, they're under 4%. A good thing for the housing market. And ultimately, we want to see if it can close under 4%. The last close under 4% was November 26th of last year. Leslie, back to you.
Rick, thanks so much. Rick Santelli for us. Let's get to the broader market with red across the screen to end the week after a hotter than expected inflation print. Joining us now is Max Kettner, Chief Multi-Asset Strategist at HSBC Bank. Thank you very much for being here, Max. Help us understand what exactly is going on under the surface, because you've got PPI, you've also got the block news and the potential, concerns surrounding replacement of jobs with AI and other bots. How would you characterize what you're seeing on the screen today?
Yeah, look, I think there is a lot of narratives going on right now. Just you mentioned the job displacement narratives, and then, obviously a couple of weeks ago, I think 2-3 weeks ago, we had the narratives around, what kind of sector are we going to sell off today, right? I woke up every day and I thought, okay, which sector is it going to be? Is it the transport and the freight sector? Or is it going to be insurance? And then one day it was commercial real estate. So I think there's a bit of a sort of a narrative, narrative inflation almost going on, and at the same time we're focusing very, very little on the data. Look at, you mentioned PPI, you guys have just mentioned Chicago PMI, but actually not only in the US. When you look across the globe, you look at the most open, most manufacturing-driven economies. Look at the likes of Korea, Taiwan, Sweden, Netherlands, Czech Republic. You're really seeing across the board some proper cyclical momentum, particularly in the manufacturing sector building up. And I don't think there is enough emphasis on that. There is a bit too much emphasis on the AI narrative. Who knows what's going to happen in a couple of years? Who knows? I think we're really ignoring a little too much, and particularly the US rate side of things, ignoring too much what's happening under the hood is a proper textbook style cyclical recovery right now.
Yeah, I think that, one of the big drivers of the moves today are financials. You've got alternative managers under pressure, big banks under pressure as well. And I'm just curious, as you mentioned the cyclical recovery, we are seeing pockets of defaults in certain portfolios, especially across the BDC landscape. How concerned are you about this being early innings of some sort of credit cycle, given what we've seen this week with those BDC earnings?
Not an awful lot, Leslie. I think the main point from your question is we are seeing pockets of the defaults. Well, actually, when we look at, on aggregate, when you look at the last sort of 15, 18 months, you look at public high-yield credit defaults, you look at things like private credit delinquencies or bank loan delinquencies in the US specifically, they've actually started to peak and go down about a year and a quarter, a year and a half ago, so at the end of 2024. And funnily enough, you guys might remember, about a year and a half, 2 years ago, it stopped that people were talking about these lagged effects and the lagged impact of rate hikes. Remember, there was the story that so many people had on for about 2 years. When is the long and variable lags of monetary policy, of that tighter monetary policy finally kicking in? And I was just speaking to a colleague actually right now. When you look at in the last year and a half, I've had genuinely not a single client ask me about, hey, you know what? Rates are coming down. That should be good for the economy. That should be good for some of those distressed debt, some of the more highly leveraged companies. Actually, we should be even looking at household debt. Look at something like credit card delinquencies. They've started to trend down as well. So yes, you are seeing those pockets of defaults, but on aggregate, the data on delinquencies is actually getting stronger right now, not weaker.
Yeah, broadly speaking, I would say in the private credit space, it's getting a little bit weaker, but part of that has to do just with all the activity that was made 6 years ago, 5 years ago during the pandemic, and obviously the world has changed a lot since then. You are max overweight equities right now. What do you tell clients who are, looking at the screen today, all the volatility in recent weeks, about just the uncertainty and the psychology of the market and how unpredictable it all is?
Yeah, look, I would say there is not just the US, and even if you are bound to the US, there's not just one sector. Look at the US, for example, in the last 3-4 months. Clearly, what we are seeing in some of the consumption data is that the lower end of the K-shaped economy, so the lower income households, they're actually starting to see a bit stronger consumption. So what we're seeing in the higher frequency data is that low income households, the consumption, that gap with the higher and middle income households, that's starting to close now. And that's really good, right? That should be helping some of those sectors that are exposed to that. So the likes of the regional banks, transport, home builders, but XRT, like things like US retail as well. And of course, if you're not bound to the US, look at other markets. Look at the UK, look at the FTSE 100 with the miners, the banks. Look at Europe overall with industrial goods and services, where you've got exposure to things like the miners, you've got exposure to things like the defense story in Europe, to things like the German infrastructure story, or the European banks. So look at in emerging markets, there is an awful lot of opportunity, I think, not just outside of the US, even within the US, away from some of those beaten up sectors. I think there's clear signs of improvements on some of the lower end of that K-shaped economy, but particularly outside of the US, that's really where I think at the moment, tactically at least, that's where the most attractive opportunities are.
Although certainly here in this country, Max, the share of U.S. delinquencies is at the highest since 17. Our savings rate is at a 4-year low. Real disposable income basically didn't grow in the second half of last year. You're counting on that not getting worse.
Oh, you guys are trying to make me bearish. No, look, guys, I think like on the one thing that I would say, however, is when you look at the wealth gains. So away from delinquencies and all that, when you look at wealth gains and you look at real wage growth, in fact, when we look at sequential real wage growth, so look at like 3-month real wage growth, for example, since the fourth quarter of 2022, that's almost consistently been positive. So almost consistently, we've seen real wage gains. That's positive for the consumer. And on the wealth side, again, even last year with the gains in equity prices, we've seen a tremendous added wealth in terms of overall household wealth. And on top of that, that has actually not been concentrated just like in the 2010s. It's not this time around been focused on the higher income households. It's the younger households, it's the lower and middle income households that have also, in the last 5-6 years, participated in these higher wealth gains. So it is, I would say, not only about delinquencies, it's also about the strong household wealth gains and the strong, particularly in the last 3.5 years, that strong sequential real wage gains.
Yeah, what you're seeing with the K-shaped economy. Capital markets certainly doing well with regard to both the private markets as well as deal flow. So we'll talk about that in a little bit. Max, thanks so much.
OpenAI raising $110 billion. Yes, $110 billion. That's the largest private fundraising ever, maybe the largest ever, period. It values the company at $730 billion. The backers, well, it includes Amazon, NVIDIA, SoftBank. Kate Rooney's been following this closely for us and has some more details. Kate.
Yeah, David, you're absolutely right. It is a record in late-stage tech financing. It's $110 billion, more than double OpenAI's last record-breaking deal from SoftBank. If you think about that last year, it's $40 billion. This time around, you've got SoftBank doubling down with another $30 billion plus $30 billion from NVIDIA. And then the biggest, newest investor here is Amazon, investing $50 billion. That's going to be coming in different tranches. So an initial $15 billion, followed by $35 billion. They say in the coming months when certain conditions are met. They didn't say what those conditions are specifically, but part of this is going to be a strategic partnership. OpenAI does plan to use a huge amount of Amazon's custom AI chips. That's about 2 gigawatts, plus creating special models to power consumer models. For example, think of things like Alexa. Amazon CEO Andy Jassy and OpenAI CEO Sam Altman appearing together on our air earlier this morning on Squawk Box. Andy Jassy saying that OpenAI is going to be one of the very big winners out there, and long term, he says Amazon can help them quite a bit in this partnership. Altman, though, responding to some questions over the circular nature of some of these deals and critiques out there that money is going to be going into OpenAI that might end up back at the hyperscalers. Here's what he said.
I get where the concern comes from, but I don't think it matches my understanding of how this all works. This only makes sense if new revenue flows into the whole AI ecosystem. If people are not willing to pay for the services that we and others offer, if there's not new economic value being committed, then the whole thing doesn't work, and it would be circular. But revenue for us, for other companies in the industry, is growing extremely quickly.
This is for Amazon, at least. If you think back to its first real bet on an AI lab, $8 billion in rival Anthropic for OpenAI. It does shake up the entire landscape here. Amazon rival. Meanwhile, Microsoft is one of OpenAI's biggest backers. Altman, though, saying that that deal is still strong. There are still strong partners there, but a lot going on.
Yeah, I saw the joint statement. And the OpenAI Foundation now is like $180 billion, is at least where its stake is valued as well. Kate, do we know anything, though, about, like, where is the money staged? Is it dependent on certain metrics being met? Not just for Amazon, where, you've already told us about, but for NVIDIA as well?
So interesting on Amazon quickly, they talk about conditions. I had heard from a source that there are 2 stages of this, 2 conditions. Basically, one is an IPO eventually. That $35 billion could come if the company goes public. The second does have to do with AGI, despite Altman saying on our air, we're pretty close to AGI, so we're trying to leave that out of deals. I'm told that is still roughly kind of a part of what they're doing. The NVIDIA side of this also appears, I haven't dug as deeply into the NVIDIA side, but it does also appear to come with certain caveats, certain chip partnerships. They are longtime partners, though, and OpenAI has long relied on their GPUs. So that is sort of standard for what you see with NVIDIA and OpenAI historically.
Kate, appreciate that. Kate Rooney this morning on some very big news in tech. Our roadmap for the rest of the hour coming up, much more on that massive OpenAI round. Dan Niles will give us his first take ahead.
Plus, the CEO of $50 billion software firm Autodesk will be with us talking earnings as that name bucks the downward trend today.
And we'll have the latest on Warner Brothers. Of course, it will be owned by Paramount if they get the requisite approvals. We'll talk about that when we come back right here on Squawk on the Street. Welcome back. Shares of Autodesk bucking the slide in software stocks that we've seen of late. After the company reported strong fourth quarter results, it did beat street expectations for guidance. Now the stock is still down about 20% for the year. Of course, on those general fears around AI disruption that have been rocking so many company stocks. Joining us in a first on CNBC is Autodesk's CEO, Andrew Nagnost. Andrew, good to have you. First on the quarter, before we sort of get to the AI conversation, your results were above the high end of guidance, I think, on revenue and margins, free cash flow, one reason why the stock is up. Some saying, though, your fiscal 27 guide is more cautious, perhaps, than might be expected, given that performance. Why is that?
Yeah, so it was a great quarter. We were up 18% for the quarter. We almost delivered $2 billion in the quarter. For the full year, up 18%. Free cash flow was up 54% to $2.4 billion. We did do it. We gave a strong guide. There's a little caution built in the guide because we did a major restructuring of our sales force, and we built some caution into the guide associated with the disruption with that restructure.
So what, it's sort of about around execution risk versus any sort of macro uncertainty?
Absolutely. We factored in execution risk. It's front loaded into the business, and we wanted to make sure that we captured that, and we did. It's captured in our guide.
All right, let's get to the bigger picture here, of course. And I know you're a veteran of this industry, so I want to hear your broader perspective. But specific to Autodesk, I think you said you're not trying to compete with frontier AI models, but kind of combine them with your proprietary data and context. So I guess what prevents one of these big AI players, though, from building directly into design and construction workflows?
Yeah, you know what? I think the market's starting to figure out its rubric for where the winners and losers are here. Who's Amazon, who's Pets.com. And what's really key to this is a couple of things you want to pay attention to, right? Are you in an industry segment where probably right is wrong, where accuracy really matters? We are in an industry segment where probably right is absolutely wrong. You have to have precision. You have to be able to deliver precision. And what do you need to deliver precision? There's a few things. You need complex context. Not simple context. You can't be working across one or two disciplines with simple data exchanges. You have to be having broad depth of context. We work across design, engineering, construction, pre-construction, manufacturing. That context breadth matters a lot. But that's not enough either. You also have to have a huge volume of scarce data you can't get anywhere else, so that you can train your own proprietary models that take you further than the frontier models can and provide that accuracy, that fidelity. And the last thing is you need the expertise. You need the people. And the markets are starting to figure out this rubric, and I think as they stress this rubric more and more, you're going to see the winners rising and the losers falling. If somebody's in just construction or just design, they're toast. Autodesk is going to be one of the winners in this.
Interesting. Yeah, I've been hearing a similar narrative from some other companies as well, this idea of probabilistic versus deterministic outcomes and how important that is. But when it comes to outcomes, I mean, if you are successful in introducing more efficiency into the overall product for architects and engineers, do you still sell on a per-seat basis, or does it have to be a different model that you approach the customer with?
Yeah, so we've been preparing for this for a long time, David. We already have a variety of models. We were the first to bring consumption to our space. We also have project-based pricing models, and we also have site-based pricing models. This is really important because in the future, we really want our customers to be having fewer people per project so that they can bid on and win more projects. Our industry has a fundamental capacity problem. Not enough people, not enough firms, not enough money or material to execute all the projects that need to be executed. So we want fewer people per project, but what you're going to see us monetizing is not just that heads, those subscription heads that are working on projects, which is fine, that's going to stay with us for a while. We're also going to monetize the project. And ultimately, we're going to monetize the owner's investment in the product as well. So we have different monetization methods, consumption-based, project-based, and we're already ready for that transition. And like I said, we've been preparing for it for quite some time, over a decade.
Andrew, everybody's talking about Jack Dorsey and Block and this notion that efficiency, we need to re-rate where we're thinking about revenue per employee and efficiency and headcount. Are you in that camp?
Yeah, well, thanks for that question, Carl. Look, I won't comment too much on Block. I think we all know there's more going on at Block than just AI. But what I will say is we are absolutely looking at efficiency moving forward. We are going to hire less people at Autodesk because of efficiency. We're certainly seeing engineering efficiency because of AI, and we're going to see efficiency in our go-to-market. We actually are getting efficiency in our go-to-market now, and we're going to continue to get efficiency. So efficiency is absolutely going to be the name of the game. Jobs are going to change. Companies are going to hire fewer people. It might not be as dramatic as what you heard yesterday, but I think there's other reasons for that.
And finally, Andrew, sort of again, as somebody who's been around this sector for a long time, I mean, this SaaS-pocalypse that has been reflected, at least in valuations, including your own to some extent, where do you see it playing out? What's the dividing line between those that will survive and thrive and those that won't?
You know, again, I say people are trying to sort the Amazon.coms from the Pets.coms right now. You got to look for that market where, you know, probably right is wrong. You got to look for that deep, complex context. If the company is managing deep, complex context, if they have proprietary data and expertise, they're going to be one of the vertical AI winners coming out of the SaaS market.
All right, we're going to watch it closely. Appreciate your insights on it all. Thank you, Andrew.
Thank you so much. Pleasure talking to you.
Still to come this morning, veteran tech investor Dan Niles will get his take on today's blockbuster news around OpenAI's $110 billion funding round. Paramount, of course, prevailing in that battle for WBD. We'll talk about what comes next. First, though, the CEO of software giant Zscaler is here, breaking down results with the shares down almost 15%. Don't go away. Welcome back. Shares of cloud security company Zscaler sinking today despite solid earnings last night after the close. Joining us this morning is Zscaler's CEO Jay Chaudhry, along with our John Fort. Morning, John.
Good morning, Carl, and good morning, Jay. Good to see you. You beat on the top and bottom lines yesterday. Your revenue guide for the current quarter slightly ahead of estimates at the midpoint, and yet your stock is down more than 14% at the moment, supposedly because of annual recurring revenue concerns At these levels, your stock's down about 35% year to date after being up 25% last year. So, Jay, is your growth slowing down?
Not at all, John. We had a fantastic quarter. We beat the high end of our guidance for revenue and profitability both. Look at our results. ARR, 25% year over year. Revenue growth, 26%. Operating cash flow growth, 14% year over year. Free cash flow, 18%. Operating margin, 22%. I think these are great numbers. And if you look at our overall performance, there are only 5 major public SaaS companies with over $3 billion in ARR that are doing Rule of 40, which means if your revenue growth and free cash flow margin together is over 40, you're a Rule of 40 company. We are a Rule of 62 company. These are great numbers. And also, with AI coming on the scene, we believe we are the platform for securing agentic communication. So I'm scratching my head and say, where did the market get it wrong?
Yeah.
We are confident about our future and our results.
There are a lot of investors scratching their heads too when they see this kind of stock action and these numbers. They think there must be something in here to explain this. Now, you did talk on the call yesterday about how you are extending Zscaler Zero Trust Exchange platform to deal with these software agents that everybody is so excited about. Tell me why you expect that there's going to be so much more volume and more work for Zscaler software to do in the agentic era.
We know AI agents are coming. For every employee, there'll be 50 to 100 agents. And all these agents are like people. They're like workers. They're going to do certain tasks, which means they need to access applications. They need to talk to other agents. Imagine an agent getting hijacked on your network. They're getting hacked. It could be crazy. Previously, we talked about end user being the weakest link. Tomorrow, AI agents will be the weakest links and could cause a lot of security issues. The best way to secure AI agents is zero trust technology, which means the technology that Zscaler pioneered, where an agent can only talk to a certain application or certain agent one-on-one, unlike firewalls. And that's the largest global exchange infrastructure we built. Well, we believe that that's the best way to secure it. Yes, please.
It sounds like Jack Dorsey at Block is going to be employing a lot of AI agents because he's cutting nearly half of his workforce. Are you going to do that? What's the role of people in this future that you see, and how much of the software that you need is going to be written by agents?
Yeah. So first of all, I do not see growing companies doing what Jack Dorsey did. Okay. Now, the hiring will slow down in certain functions and it'll grow in certain others. At Zscaler, we are hiring a number of developers who are actually AI savvy. Now, some functions may have slow growth, but many functions will get sped up because of AI agents, and they need to be secured. We are in a best place to provide zero trust secure communication for those agents. And the more the number of agents, the more the traffic, the more the opportunity for Zscaler to monetize it.
Jay, one of the biggest themes that I'm hearing about this earnings season is sovereign data. And I'm hearing CEOs talk about the breakdown in trust between the US and Europe and how it's causing some European governments and even European companies to back away a bit from US-based hyperscalers. Is that an opportunity for you, or is there any blowback, any hesitancy to deal with US-based security companies as well?
It's a very good question, John. Sovereign data and sovereign cloud is a big topic. Zscaler was designed to be able to have sovereign data in different parts of the world. 5 years ago, and even longer than that, when Europe wanted GDPR, that say my data stays in Europe, Zscaler was already designed to do that. So we are offering sovereign cloud security for our customers in Europe or in Asia and different parts of the country. It is a good opportunity for us.
So last question, I want to go back to the guide here because that seems to be the question a lot of people have. Maybe they're using a metric that you don't focus on anymore, but this annualized recurring revenue pipeline, what is influencing it? What are the areas where it's growing? Are there old products cycling out that are perhaps slowing it down?
We increased our target for the rest of the year. So I think we are bullish about ARR. ARR is the metric we're using. ARR is growing for our core products. ARR is growing for our new products, such as Zero Trust Branch. It's growing for our AI security products. So we are personally very bullish about the growth of ARR, as well as operating margins. If you look at all metrics that matter, we're done well. Look, investors always want more. I always want more too. But if you look at the solid numbers, we are strong, our customers are loyal. We did the largest number of $1 million deals in a second quarter. Across the board, performance is good, and the opportunity of the agents is fantastic for us.
Eventually, it'll all pencil out. Jay Chaudhry,
Indeed.
thanks for joining us first here on CNBC,
Thank you, John.
the CEO of Zscaler. Carl?
John, appreciate you bringing that to us. That's our John Ford. Let's get a CNBC News update this morning with Seema Modi. Hey, Seema.
Carl, today is the former President Bill Clinton's turn to face the House Oversight Committee for a deposition in its investigation into the latest sex offender Jeffrey Epstein. The former Secretary of State Hillary Clinton appearing before the panel yesterday. Today's proceedings make him the first sitting or former president to testify before members of Congress in more than 40 years. Pakistan said today it is now in an open war with Afghanistan over the two countries exchanged attacks overnight. Afghani officials saying they were retaliating for deadly airstrikes on Sunday. Tensions have been high for months as Pakistan accuses the Afghan Taliban for providing support to militant groups. And the Pentagon is threatening to withdraw its support from Scouting America, formerly the Boy Scouts, if it does not implement policy changes. Defense Secretary Pete Hegseth said today that includes a reimbursement members use biological sex at birth and not gender identity. Hegseth says the Pentagon will review the changes made in 6 months and will end its relationship if it does not comply. Leslie, I'll send it back to you.
All right, Seema, thank you. After the break, Netflix bowing out of the battle for Warner Brothers Discovery. The details and what could come next. And we have a programming note to share with you. We've got a big interview you won't want to miss on Tuesday at 10 a.m. Eastern. The CEO of Target on earnings day live with Sarah Eisen at their headquarters in Minneapolis in his first interview since taking the job. We're back in a moment.
Welcome back. It's over. Warner Brothers going to get bought by Paramount, Skydance. Probably should have won this thing early. They had to wait a long while and raise their price a lot and guarantee a lot more in terms of providing the certainty the Warner Brothers board wanted, having been very uncomfortable with the so-called LBO structure. We've detailed so much of this over time. Where do we end up? 31 in cash. If this thing does go past the end of September, you get 25 cents a share for each quarter after that. They increase the reverse termination fee, remember, if they don't get regulatory. And Netflix is going to get paid today. $2.8 billion coming to them in that breakup fee that Paramount said it would pay. It's going to wire the money as soon as they sign. Haven't been told they've signed quite yet, any minute now. And, you know, there are some of the other things that were a part of creating the certainty. We talked about that earlier in the week. We said, of course, it would lead to it being deemed superior. It was. The question was, what will Netflix do? And Netflix chose not to respond. It would have required at least a bid of another $2.50 to perhaps as much as $3 a share in cash to match, so to speak. Match doesn't mean you have to match exactly. And of course, remember, the two deals were never the same either. Paramount's buying all of Warner Brothers Discovery, including those cable networks, led by CNN. Whereas Netflix, of course, was just buying the studio and streaming assets. And now it's going to go its own way. Many of its shareholders perhaps wondering what this was all about as many chose to sell. That stock got hit hard, down as much as 25% at one point from when they announced the deal. And it is rebounding sharply and has in the last couple of days, as well as it appeared likely that Paramount would potentially prevail or at the very least force Netflix to come back. And that is also a key here. Netflix might have chosen to come back, but Paramount was probably going to have to and would have raised again. This was kind of more existential for them than it was for Netflix. Netflix said that all along, not a must-have, but a nice-to-have. That said, it is rare to see a company bow out before even trying to raise one more time. We've seen it. Anadarko and Chevron comes to mind. Chevron for Anadarko, where Oxy came in, and they just said, fine, sold to you. But it doesn't happen that often.
Especially with the reverse termination fee that is owed. And, I mean, maybe they're looking at this as a potential competitor that now has a lot of debt on its books. And we've seen that movie before with media. And does it weaken them in a way by having gotten them to, you know, raise the price so significantly? Now they have all this debt. They get obviously the $2.8 billion from the reverse termination fee, but
no, it's the regular breakup fee.
Yeah. Oh, it's the regular.
That's the breakup fee. That's what happens when the company you're acquiring says we're not being acquired by you.
So Netflix,
right? Reverse is when it goes from the company, the company acquiring to the acquirer.
But there always was an undercurrent of tails they win, heads they kind of also win.
Yes.
By hobbling a competitor.
Absolutely.
And now there's some stuff crossing on state review, whether states would have to make a stand if federal doesn't.
And that is a question here for the Paramount deal. Will state AGs, and again, we saw some of the so-called red states step up against Netflix only this week, and the question is, will other states choose to do the same in terms of Paramount? And Europe will play an important role here regulatory-wise and how they define the streaming market. But, you know, it's expected to get approval. The Paramount side, from what I've heard, certainly thinks they will get it done prior to having to pay this ticking fee. But to your point, both Carl and Leslie, they're going to have an enormous amount of debt. They're going to be over 7 times levered with a company that right now 70% of its cash flow comes from linear cable networks. And so they're going to have to deliver on those synergies. $6 billion in synergies they see to bring that leverage ratio well down and succeed, which obviously is the plan for David Ellison.
Is there a sense that, you know, given the cable networks were kind of one of those, I don't know, maybe this is not true, but it felt like throughout the negotiations, it was like, okay, we're going to take it all, we're even going to take the cable networks. Is that going to be kind of the key part of where they see the synergies as a result of that? Because, you know, it seemed almost like something that they got because they had to, not necessarily because...
Yeah, I mean, they said all along they sort of liked it. Obviously, CBS is the key asset Paramount has coming in many ways. We saw their results yesterday. They lump it all together. It's hard to see exactly how they're performing. But we know linear cable networks, particularly entertainment cable networks, very different from CNBC.
Obviously.
Are tough, really tough. And so, yeah, I mean, there are going to be a lot of money saved between CNN and CBS in terms of news gathering, for example. But putting 2 studios together also could save you a lot of money.
Yeah.
Also, as Tom Rogers pointed out this morning, 5 straight quarters of declining rates of decline of cable sub losses.
Yeah,
which is not the worst thing in the world.
No, and in fact, remember the charter quarter, we actually saw
Yeah.
video subs go up.
Yes.
So, there is a hope that we're sort of at the end, so to speak, of the great unbundling.
Great unbundling.
Great unbundling.
Still to come this morning, longtime tech investor Dan Niles joins us with his first take on this OpenAI blockbuster new funding round. As we go to break, watch crude. This would be the highest level since August after this latest round of U.S.-Iran talks in Geneva ended with no deal. Looks like we will return to $3 retail gas maybe as early as next week. Stay with us. Tech shares are slipping today, adding some more losses on the month as we close out this month of trading. NVIDIA extending its post-earnings slide as the company joins Amazon and SoftBank in OpenAI's blockbuster funding round. Let's bring in Niles, investment management founder and portfolio manager Dan Niles. Try to put this crazy month of news into some framework, Dan. What does a tech playbook look like at this moment?
Well, I think the tech playbook is the same as it's been coming into this year, which is you better be selective because there's going to be a lot of cross currents as we go through AI displacing certain companies in the software space. You're going to see more cockroaches, as Jamie Dimon said way back in October, which everybody dismissed. And I think that's really the key. And then what I'm liking to say right now is you have to get messy. And what I mean by that is utilities are up, materials are up, energy is up, staples are up, industrials are up, and they're up between 10 to over 20%. And so you've got a problem if you're in the areas that AI is going ahead and disrupting. But if you're in the heavy asset industries where you have little chance of AI replacing you and it may actually help you, then that's a pretty good place to be. And so that's why I think, when 5 out of the 11 subsectors of the S&P are up between 10 to 20%, that's pretty good. And it tells you the areas you need to be careful.
So you're saying you'd rather play in the so-called halo, heavy asset, maybe even consumery playground as opposed to picking through wreckage in the IGV?
Well, no, I think with the IGV, you just need to be careful because think about it from a timing perspective, right? Mark Andreessen came out with that piece for the Wall Street Journal that software is eating the world back in August of 2011. And for 14 years, it's been, essentially a one-way trade higher. You've got AI now coming in, and I do believe there's going to be a lot of displacement happening there. And you haven't found the new levels that these companies need to trade at in 4 months. I think this is going to be a long, drawn-out process, and you've seen that over the last couple of months, especially as you've gotten these plugins for different areas, like whether it's real estate brokerage or truck brokerage services or insurance, wealth management, etc. And that's going to take some time. So we haven't found the bottom yet for IGB. It doesn't mean you're not going to get some great counter trend rallies during that. And I do think security and database are two areas that ultimately will be in good shape. But much like we saw with Amazon in 0102, it doesn't mean that the good companies aren't going to get crushed along with the bad ones like Pets.com or Webvan, as we're trying to figure that process out, which ones are going to win or lose.
Yeah, but I wonder, Dan, isn't now the time to maybe figure some things out? I mean, we had the Autodesk CEO on with us about 10 minutes ago or so, talking about their business model, and deterministic outcomes versus probabilistic, and how they've already changed their business model away from seats. I mean, I would think there are some opportunities out there, perhaps.
Well, here's the thing, though, David. Go back to the Amazon example, right? Between 2000 to 2002 or so, you had revenues at Amazon double. The stock went down over 90% because it was caught in that space. So do I have some longs in software? Do I have some shorts in software? Absolutely. But, I worry a lot more about my longs because of what happened in 01, 02. Now, I don't think it's 01, 02. I think this is more like, 97, 98, where you had Cisco go down 37% and 38% during the year, and then still finished the year up. I think it was like up 31% in 1997 after being down like 37, and it was up 150% in 1998. But, if I am wrong, and it is closer to the 2000 period, there's still a lot more carnage to happen. And, we saw that with, okay, you might not believe it, but then you look at Snap and you go, oh, or it's not Snap, sorry, XYZ, and they're laying off a whole bunch of people, right? So you have to think of both sides, I think.
You do. All right. What about NVIDIA? I know, I guess I go back to when didn't you used to cover chips a long, long time ago, Dan? Am I remembering that right?
Mm-hmm.
Yeah, when I was in the age of the dinosaurs, I was a semiconductor analyst. So you remember
all right. So, reports of this incredible quarter and the stock's done nothing but go down. Is it sending some sort of signal?
Well, it is in the sense that I don't think it's necessarily that bad in the sense that people are starting to get more discerning, right? Because up until about October, every announcement was considered good in the AI space and everybody was going to win. I like NVIDIA, to be clear, because I look at them and I go, with the massive uptake in token generation you've seen so far year to date, it's literally doubled from the end of last year to now because of these AI plugins that we're seeing. You need to run that on hardware. And NVIDIA is the gold standard. Now, if it was trading like Cisco was at 150 times earnings at one point back in 2000, that'd be a problem. But it's trading at 24 times PE. The market is at 23 times. So it's telling you that people think numbers are going to get slashed aggressively at NVIDIA, because otherwise it would not be trading at these levels. So if you're running, a long short book like I am, you go, well, this is my long, because at that valuation level, I'm a lot more comfortable with that. They generate a ton of cash. So they're not like their customers who are burning cash in some cases. And so you've got a strong balance sheet, cash flow generation. They are the gold standard. And at that multiple, it's way better than almost anything you can find in tech, if you're just looking within tech, to be invested for the AI.
It has been quite the week, Dan. We'll get you back soon. Talk some macro, this PPI print, and more next time. As always, have a good weekend. Dan Niles.
Thank you.
Bank stocks pacing for their worst day since April of last year. What's weighing on the sector next? And speaking of the banks, a big interview on Monday. I'll be sitting down with JP Morgan Chief Jamie Dimon live from their annual Global Leveraged Finance Conference in Miami Beach. A lot to talk about there, especially against this backdrop. That's at 1:30 p.m. Eastern on the exchange.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Financials getting crushed today again in the trading. American Express, the worst Dow performer this morning. The KBW Bank ETF on pace for its worst day since April of last year. I think today's moves we can attribute to some credit quality fears. We have a bunch of these BDCs reporting, business development companies, which are showcasing a slew of troubled loans, and as a result, they're slashing the dividends, the distributions that they pay investors, some pretty significantly. I know you guys were watching that FSK, the Future Standard KKR BDC, that yesterday was down about 15% as a result of this. They slashed their distribution by about more than 30% on a quarter-over-quarter basis. And you've got this MFIC, that's a BDC overseen by Apollo, kind of a similar story, not as severe of a slashing of that distribution. And then you've got MFS, which is the UK mortgage finance company that essentially imploded, and it really rhymes with a lot of the situations we saw back in the fall with the cockroaches and the alleged fraud and the double pledging of assets. And so we're starting to see the banks that were exposed there, and that's creating some additional jitters. You've got Jefferies down significantly on this because it had exposure, Apollo exposure to both that as well as what I just mentioned with regard to the BDC, and then KKR. Again, you see the manager there down 5.4%. Its BDC was down pretty significantly yesterday, too. So all of this is credit quality concerns as well as just overall sentiment concerns that have already been so volatile this year as a result of a slew of factors.
You can't ignore the credit card issuers. Capital One's down 20% for the year. Visa, MasterCard down 10. You mentioned Amex. I don't know if that's AI disintermediation or concerns about consumption growth slowing and transaction volume?
It's a good question. I mean, as you kind of try and figure out what is at stake with the consumer right now, a lot of these troubled loans in the BDC world were things that were exposed to consumers. They were kind of old world types of businesses, dental roll-ups, residential construction companies, things like that. So maybe there's a read-through on kind of the state of the consumer and the state of the broader economy.
No shortage of topics for you to talk to Jamie Dimon about on Monday.
No shortage.
No.
There never is,
No,
but especially
even more
right now.
so now.
At a leveraged finance conference, it's going to be very well timed.
Right.
After the break, we'll talk about Block's mass layoffs, these fears around AI's impact on jobs, as we're getting some movement off the session low. Stay with us. Good Friday morning. Welcome to Money Movers. I'm Carl Quintanilla with Leslie Picker here at Post 9 of the New York Stock Exchange. Sarah Eisen's off today. Block slashing its workforce nearly in half, with CEO Jack Dorsey warning that all companies will eventually follow suit. But is an AI jobs apocalypse really upon us? We'll talk about it.
Plus, Anthropic saying it won't abandon its ethical red lines and bow to Pentagon pressure for its powerful AI model. We're joined by a former Department of Defense AI strategy insider for unique insight on the path ahead.
And as OpenAI closes a massive new funding round from Amazon, we'll talk about whether Anthropic is really the new AI kingmaker in town. Trying to come off of these session lows, the S&P back briefly below 6850. Dow's going to be interesting to see whether or not it can hold its 10th consecutive monthly gain. I think for that, Mike Santoli, we need 48,892. It's going to be close.
It will be close on the Dow. It looks like the S&P is off the board for the 10th straight. I think for the S&P on a total return basis, if it was up this month, it would be 10 straight. Probably not going to get there. I mean, we're 2 months into the year, and the S&P 500's year-to-date performance rounds to flat, basically, and yet it's been so dynamic below the surface in this uneasy equilibrium type way. So more of that today. Now, typically the way this has worked is the mega cap tech, the hyper concentrated indexes have tried to rebalance away from the AI trade, and cyclicals are right there to take up the slack. Not today. Today, it's all defensives. The PPI number, the kind of geopolitical what-if trade on Iran, I think is getting in the way of that. So you now have yields down, despite the hot PPI number. Who knows what that's pricing in, except that the Fed's going to have to do something. Maybe the labor market's going to be weaker. At the same time, home builders can't get a bid. Consumer discretionary is not leading. Transports are down. Of course, you were talking about financials being down, too. So all that stuff suggests that this is a little bit of at least a mini one-day growth scare, but we still hold up. The median stock coming into today in the S&P was up 7% year to date with a flat index. And so I think whether you think that's victory or kind of a struggle, it depends on how you define what game you're playing. Are you just trying to beat the index? Or are you hoping that the aggregate value of stocks goes up and helps us get where we need to go when you have $700 billion of capex hitting the economy, in the next 10 months?
How much weight do you give to the Block news and just the kind of wake-up call that it might have? Not that we needed a wake-up call, because we've been kind of waking up to wake-up calls every day for the last few weeks now. But in terms of just job replacement and AI and actions taking place right now and what it means for the economy?
I think it gets in investors' heads, but also just aggravates that exact anxiety point that they've been worried about. So I don't think anyone is running the numbers and extrapolating this through other companies and saying this is what it's going to mean for aggregate employment. I do know people who have believed that, like, the 5-year Treasury yield was lower than it otherwise would be because we are discounting a lower terminal rate. We are discounting the labor market is going to have these air pockets. We're not going to get jobs recovering, and therefore the Fed can do more. I don't know if that's true. I do know that people believe it's somehow the market's trying to price these scenarios. I think what it is we're at least trying to give more weight to that end of the probability spectrum, that we continue to have this sort of jobless boom. Maybe it's productivity. Maybe we call it productivity. Maybe we call it hollowing out of the labor force. So I don't know exactly. I think we need like 3 or 4 more big examples from a company that was not considered badly mismanaged and the stock was depressed and it's now bouncing to a level it traded at a month ago. Okay, so we're not necessarily saying we've remade the corporate America on AI rails.
No, that makes sense. Mike Santoli, thanks so much. Appreciate it. Let's get to more on Block. Those shares are, as Mike said, jumping today after the company slashed its workforce by nearly half. Mackenzie Sigalos joins us with more on that story. Hey, Mac.
Hey, Leslie. So this is one of the most dramatic restructurings that we have seen in tech. Block cutting 40% of its staff of 10,000, and CEO Jack Dorsey is directly attributing the move to AI. On the earnings call last night, he called this a fundamental shift in how you build and run a company.
Intelligence tools have changed what it means to build and run a company. We're already seeing it internally. A significantly smaller team using the tools we're building can do more and do it better. And intelligence tool capabilities are compounding faster every single week. I don't think we're early to this realization. I think most companies are late. Within the next year, I believe the majority of companies will reach the same conclusion and make similar structural changes. I'd rather get there honestly and on our own terms then be forced into it reactively.
Now, investors bought into that message immediately. The stock jumped after hours. It's still up around 16% right now, even though the quarter itself was mostly in line. And that reaction was helped by the fact that Block is still growing from a fundamentally solid position. Gross profit and cash